Hi, today I'm going to be sharing with you the biggest misconception about credit card debt, interest rate, and minimum payment. And it's so important you tune in. So let's get right to it. Today, your daily dose of financial advice comes from an experience I had while working at the bank. I actually wanted to encourage my client to A, pay off their debt, but B, utilize the opportunity to improve, I guess, their financial situation at the time. And that hasn't changed. What I started to realize, and I'll tell you this, it came from my own experience by being in debt myself. I realized that a lot of people really rely on credit cards, lines of credit, loans, and of course, mortgages, because of course, we haven't learned early enough in life how to save money properly so that maybe we don't rely on debt so much. But there's always hope. And that is the hope that I hope to bring to people is to educate. And one of the biggest misconceptions about specifically credit card is people seem to think that because their minimum payment is low, they have a great credit card rate, interest rate. And more times than not, I had people who really didn't know their interest rate on their credit card, which, by the way, that's how that it's supposed to be. I mean, that's how credit card companies get us. First of all, they promise us a really low rate, but then in small print, they indicate that the rate's going to go up, whether it's in a year or 6 months. Anyways, a lot of people don't realize the nature of the credit card interest rate. So what I mean by that is the credit card interest rate is moving whenever prime rate moves. So prime rate here in Canada is the bank lending rate. And when you take a look at prime is probably the lowest lending rate you could ever get at the bank. Okay. Now, I won't go too much detail as to what, how rates are kind of determined, but credit card rates are variable. And you have two types of interest rates. You have fixed and you have variable. Okay. Fixed is when you have a rate that's guaranteed for a specific term and it doesn't move. Okay. So a very good example is a mortgage 5-year fixed term rate, right? If you're going to be getting a mortgage rate, typically the banks tend to promote the 5-year rate, and typically it's a 5-year fixed rate. So for instance, if your 5-year fixed rate is 5%, you're guaranteed to have your mortgage rate at 5% for the 5-year term until you have to renew again. Okay. Same thing with car loans. They're very similar as well, depending on if you take a fixed rate or a variable rate. Now, a variable rate is a rate that it has a premium, I would say, a premium above prime. It is very rare you're going to get any kind of debt below prime. In fact, if you're going to get any rate below prime nowadays, you usually have to put your house as collateral. So if you think you have a rate lower than prime, I would challenge you to that. Either way, your credit card rate, some mortgage rates, line of credit rates, they are all variable, which basically means that typically they are usually a premium above whatever the prime rate is. So whenever you hear the news and the news says, Government of Canada raises the bank's lending rate again, chances are you're going to see a little bit of a difference on your credit card rate. Okay. Now, what does this all mean? Really, at the end of the day, this just means that you just need to get out of debt. Okay. I just wanted to give you information so you understood how the credit card rates work. Now, to bring me back to my story about how I realized people thought about credit cards, basically when I take a financial review from a client, one of my goals is to show them how soon they can be debt-free. And by the way, guys, if you're at all interested in finding out that debt freedom date, please click on the link below because I am happy to share with you what I do and see if there's an opportunity for me to help you become debt free as well. So click on the link below. We'll schedule a very short chat and I'll show you exactly what I can do for you. Anyways, so when I sit down with a client and I'm building up their financial plan, I usually like to point out when they're going to be mortgage free, debt free, everything debt free. Now, how awesome would that feel to know that you don't owe anything? I've always thought of debt being another tax that you yourself brought on. Because let's face it, when we get paid, we complain about, oh, I don't see any of my paycheck. It goes to taxes or whatever you're complaining about at the end of the day. But a lot of our money goes to taxes. And that's a totally different conversation. We can talk about how to reduce your taxes in another video. But nonetheless, I think that when you think about it, a lot of your paycheck doesn't just go to taxes. It goes to your debts. It goes to your mortgage. And these debts are basically a tax on our income. Except it's a tax on our income that we can get rid of. We don't have to pay if we controlled our spending. It's something that So whenever I sit down with a client and I get their financial plan going, one of the biggest things is getting them debt-free. My job is to help them get debt-free as fast as they can, because what they could be doing with that extra money is they could be putting it towards something they love, something they enjoy doing today, not pay for the fun that they had yesterday, because let's face it, that's pretty much what credit is, right? It's us paying back the time and the things that we bought back in the day, right? That's why it feels so empty when we make those payments, because we're not getting any benefit in the present day from them. Anyways, so my job is to kind of list all the debts, including the mortgages, including the loans, even maybe debts that they have from mom and dad, whatever. And I start to list all of the debts, all of the payments, all of the interest rates, and the minimum payment. And one of the things that really stood out for me was when I'd ask them, what's your interest rate on your credit card or your MasterCard, your Visa, whatever. It's like, oh, it's a really low rate. I think my payment's only like $200. So they got the idea that their interest rate on their credit was low based on the payment that the bank told them they could pay. And $200 on what? So what you should be doing is figuring out, first of all, read the statement, because on the credit card statement, you'll see the fine print. It'll say your minimum payment is the greater of $50 or a percentage of your statement value. Okay? Whichever is greater. Longer there. When I used to work at the bank, it was always that the minimum payment on a credit card was 3% of the outstanding balance. Now, things have changed since. There are a lot of credit cards out there that will require that the minimum payment is just interest only. Interest only. So what does that mean? Interest only is taking the interest rate on your credit card, multiplying it by the balance of your statement. So like what you owe at the time. Take that and you divide it by 12, basically. Will tell you what your interest payment for that credit card is. So for instance, if you did have a balance of $5,000 and you took that, and let's say that your interest rate, let's say that your minimum payment interest rate that they want you to pay is 3%, then this person should be paying $150 for minimum payment. Okay. Now, it has nothing to do with the interest rate of that particular credit card. In fact, so if we take a look that their minimum payment is 3% of $5,000, okay, which is $150, then technically, so the credit card interest rate is 20%, and of $5,000 over the course of the year, you're paying $1,000 just in interest. Okay. If you took that divided by 12, of that $150 minimum payment that the credit card company is telling you you could pay as little of, $83 of that $150 minimum payment is going towards just interest. Okay. Now, this is just a very simplified calculation of what your interest that you're paying on your credit card payments actually is. But what's interesting is when I asked, what was your interest rate? Had no idea, but they thought that it was super low payment. Their minimum payment was so low. It gave them the impression that the credit card interest on their credit card was low, which is not the case at all. So what does this all come down to? It really just comes down to get your debts paid off. And if you're kind of unclear about how to do it, reach out. Because I bet you there are certain things that you may not know about credit card debts, which is kind of keeping you stuck at being in debt. And trust me, I know exactly how you're feeling. I know exactly how you must be feeling. The only thing you need to do is don't feel guilty, don't feel ashamed. Just do something about it now, because right now you can't unsee this video, and now you have a choice. Anyways, I got you all. I hope you got value from this. Like, comment, share, subscribe to my YouTube video, and I hope you get value from all the videos going forward in my weekly daily dose of realistic financial advice.